How to buy an investment property. Hi, if we haven't met before, my name's Dan and I'm a CMAP qualified mortgage and protection advisor. This video is purely for educational purposes only and should not be seen as advice or a recommendation to act, and I must stress your property may be repossessed if you do not keep up with the repayments on the mortgage. Before I get started, I must stress some of the mortgages on investment properties are regulated by the Financial Conduct Authority, and this video is purely based on buy-to-let mortgages that are not regulated by the FCA. Please seek professional advice before applying for a buy-to-let mortgage on an investment property. What is a buy-to-let mortgage? This is where you purchase a property that you will rent out to somebody else. It's a specific type of mortgage to purchase the property that allows you to buy a property as an investment. You then let out the property and act as the landlord for the people who rent it. You charge them rental payments to cover the mortgage and your other costs. Who can get a buy-to-let mortgage? Each lender has different requirements for buy-to-let mortgages, but they will only accept your mortgage application if they think you can afford it. They will base this on how much rental income they expect you to get from the property and also your financial circumstances. These are the two main factors they'll assess to decide how much they were willing to lend to you. Lenders will look at how much rental income you will get from a property and compare this to the monthly payments you would have to pay on the mortgage. The rental income will usually need to be at least 125% of your mortgage repayment. This means it would cover the full mortgage payment plus another 25%. For example, if your mortgage repayments came to £400, you would need to be able to charge at least £500 rent each month. They will ask you to confirm your annual rental yield and check with a local surveyor that you're likely to get this much by looking at how much similar properties in the area charge. Lenders will also decide if you can afford the mortgage by looking at how much the repayments will be and your credit record. If you would like to know how to carry out a credit search on yourself for free, watch this video. Many lenders only accept you if you earn more than their minimum income requirement, which is typically around £25,000 a year. This is to make sure you're able to afford to pay the mortgage if your tenant doesn't. Lenders will also often check what you spend and what you already owe on your mortgage, your own home, loans and credit cards for this very reason. Buy-to-let mortgage versus residential mortgage. Buy-to-let mortgages are a lot like ordinary residential mortgages, but with some key differences. The fees tend to be much higher. Interest rates on buy-to-let mortgages are usually higher, and the minimum deposit for a buy-to-let mortgage is usually 25% of the property's value, although it can vary between 20 to 40%. Most buy-to-let mortgages are interest only. This means you pay the interest each month but not the capital amount. At the end of the mortgage term, you repay the original loan in full. Buy-to-let mortgages are also available on repayment basis. Most buy-to-let mortgage lending is not regulated by the Financial Conduct Authority. There are exceptions, for example, if you wish to let the property to a close family member and are assessed according to the same strict affordability rules as a residential mortgage, and I strongly recommend you seek professional advice surrounding this. How much can you borrow on a buy-to-let mortgage? The maximum you can borrow is linked to the amount of rental income you expect to receive. There is also a facility called top-up slicing if the rental income falls short. Lenders typically need the rental income to be 25 to 30% higher than the mortgage payment. To find out what your rent might be, talk to local letting agents or check the local newspapers to find out how much similar properties are rented for. Where can I get a buy-to-let mortgage? Most of the big banks and some specialist lenders offer buy-to-let mortgages. It's a good idea to talk to a mortgage advisor such as myself before you take out a buy-to-let mortgage, as they will help you choose the most suitable deal for you. So, things to remember. It's important to do some research into the type of product and features you need before making a purchase or changing mortgage lender. Don't just look at the headline rates offered on the mortgage. There are often other fees and charges involved. Make sure you've planned for the future. You shouldn't assume your property will always have tenants. There will almost certainly be periods when the property is unoccupied or rent isn't being paid, and you'll need to have financial cushion to meet your mortgage payments. When you do have rent coming in, use some of it to top up your savings account for this reason. You might also need savings for major repair bills. For example, the boiler might break down, or there might be a blocked drain. Please don't fall into the trap of assuming you'll be able to sell the property to repay the mortgage. If house prices fall, you might not be able to sell for as much as you'd hoped for. If this happens, you'll be left to make up the difference on the mortgage. You must also remember to declare your buy-to-let properties at the end of each financial tax year. Mortgage lenders and the HMRC are coming down hard on non-disclosure, as buy-to-let property is classed as a form of income in most instances. I'm not a qualified tax advisor, so I can't speak about this in great detail, but there's likely to be income tax and capital gains tax that would need to be paid throughout the property ownership and the sale of the property. So please speak to a tax advisor about this. This probably sounds all quite daunting and like there's a lot involved. Hopefully that isn't the case, but if it is, then please feel free to ask me any questions you like in the comments below. If you have ever wondered the differences between interest only and repayment mortgages, I've got you covered with this video. Remember, your property may be repossessed if you do not keep up with the repayments on the mortgage. If you found my content helpful and you wish to buy me a coffee, I've put a link in the description below. But even more importantly, if you need my help, please contact me. See you next week.